mind, looking for a dime. James Locke in the house, gonna help you shine.
Welcome to the Poole Locke YouTube channel. I'm James Locke. Today we're going to answer some of the Ask James questions of the day. And our first question is from Tyler. And Tyler asks, if interest rates are going to go back down, keep going down, how will you be able to generate 4% income from interest and dividends? That's a critical concern for retirees and those planning for retirement, especially in today's, declining interest rate climate, really. So let's explore how you can navigate generating a 4% income from interest and dividends despite these decreases in interest rates. And we're really going to keep it focused on reducing risk and volatility in your retirement portfolio. First, it's true that when interest rates decline, the yields on traditional fixed income investments like the 10-year Treasury bond also decrease. For instance, you mentioned that currently a 10-year Treasury, I've mentioned before, that a 10-year Treasury might yield around 4%, but if rates were to drop significantly, that would decrease. Long-term bonds might offer slightly better yields, 4.7, 4.8, but they lack flexibility and do not provide a hedge against inflation. Now, in practice, many investors seeking income in retirement diversify beyond Treasuries. They explore a range of income-generating investments that offer a balance of yield and stability. Now, this approach typically involves a mix of dividend-paying stocks, corporate bonds, municipal bonds, real estate investment trusts, potentially annuities, depending on individual risk tolerance and financial goals. Now, at our firm, Sound Income Strategies and Poole Locke, even during periods of historically low interest rates, we've consistently helped clients achieve 4% income from interest and dividends after accounting for investment management fees. This has been possible through a strategic allocation across various asset classes that offer income potential while managing risk. It's crucial to note that this strategy includes actively managing callable bonds and other callable investments to mitigate reinvestment risk if they are redeemed early or mature in a declining interest rate environment. The key takeaway here is that adapting to lower interest rates requires a forward-thinking approach and involves exploring different types of investments and potentially adjusting your portfolio strategy to maintain income goals while considering the impact of market fluctuations. For instance, in a lower interest rate environment, you might need to allocate more towards dividend-paying stocks or explore alternative fixed income options that provide a stable income stream. Furthermore, now could be an opportune time really to consider locking in favorable rates before they drop too low for the long term if you're nearing retirement or already retired. This proactive approach can help mitigate concerns about future income generation amidst potential interest rate declines. So really, in conclusion, while the landscape of interest rates may fluctuate, there are still viable strategies available to generate a 4% income from interest and dividends in retirement by diversifying your portfolio strategy and adapting to changing market conditions. You can enhance stability, reduce volatility, and maintain a reliable income stream throughout your retirement years. Remember, it's about finding that right balance between income generation and managing risk effectively in your investment strategy. Great question. As always, if you would like to send in a question, you can do so. You can email that question to poolelock@poolelocke.com. Moving on, second question of the day is from Karen. Karen's wondering, how do I know if my financial advisor specializes in income like you do? Critical question, especially if you're focused on generating income in retirement like our clients are. So let's dive deeper. How can you identify if your financial advisor specializes in income strategies like what we emphasize here? So first, as you noted, many advisors tend to be more focused on total return rather than prioritizing income. Total return, as we often discuss, consists of income, I, and growth or capital appreciation, right, G. So one straightforward way to gauge if your advisor specializes in income is to look at your investment statement. Do you see a dedicated income column? Typically, this column will show the income generating from your investments. If this column is absent or not prominently displayed, it could indicate that your income generation isn't a primary focus for your advisor. Next, let's talk about bond funds versus individual bonds, right? Bond funds are indeed a tool for generating income, but they operate differently from individual bonds. Here's why. Individual bonds are often preferred in retirement planning. First, they provide a predictable income stream because you receive regular interest payments until the bond matures. Second, at maturity, assuming no default occurs, you receive the bond's face value back. Now, this dual guarantee, the dual guarantee from the bond is the steady income payments, and the return of principal is crucial for retirees seeking stable cash flow. On the other hand, bond funds are collections of bonds held within a mutual fund or ETF structure. While they offer diversification and liquidity benefits, they do not provide the same guarantees as individual bonds. Bond funds' income payments can and do fluctuate with the market conditions, and there's no assurance of principal repayment as with an individual bond. So if your advisor primarily uses bond funds rather than individual bonds or bond-like instruments, it may suggest they're more oriented toward the capital appreciation focused strategies rather than the income focused strategies. Income specialists often prefer the control and predictability that individual bonds offer, aligning closely with the needs of retirees who prioritize consistent income. So in conclusion, assessing whether your financial advisor specializes in income strategies involves examining your investment statements for an income column, understanding the types of fixed income investments in your portfolio. And by focusing on generating reliable income while managing risk, income specialists aim to provide stability and peace of mind during retirement. If you find your portfolio lacks these elements, it might be worth discussing with your advisor how to better align your investment strategy with your retirement income goals. Remember, your financial strategy should reflect your priorities and risk tolerances, especially as you approach or enjoy retirement. Great questions. If you would like to send in your question, you can do so. You can email them to poollocke@poollocke.com. And if you like what you heard today, go ahead and like and subscribe to our channel. I'm James Locke, your retirement income source, and I'll see you next time.
Money on my mind, looking for a dime. James Locke in the house, gonna help you shine. Retirement is near, don't you live in fear. Listen up, my friend, let me make it clear. Savings